Welcome, guys. Billionaire Acquisition Mastermind, the number one podcast in the world. We're here with Ansi Monsión and Douglas. So, Douglas, if you could present yourself very briefly.
Absolutely. Good evening, everyone. My name is Doug Radtke. I had 25 years of corporate development experience, and that is a combination of executive positions in mergers and acquisitions in publicly traded companies, and as a consultant for medium, privately held companies and uh, private equity owned firms. We'll talk tonight about various aspects of transaction type considerations, and then we'll open it up for questions as well too after I give a brief overview.
Perfect. So, Ansi.
Yeah. So everybody know me. Doug, do me a favor, mute your mic for me. We have some background noise a little bit.
Ansi, if you could get a little closer as well.
Yeah, can you hear me? Coming in loud and clear?
There you go.
All right, perfect. Yeah, everybody, hey, it's me, Unsee. Once you see me, you can't unsee me. Again, nothing special here, So, hey, let's just get straight to the point. Let's get rocking, guys. Hopefully everybody's ready. Everybody's, in the chat. Guys from Facebook, they're checking in as well. So we're going to have a fire podcast tonight.
Perfect.
Let's go, guys.
Perfect. So, how can we start? And what topic you want to start it on?
Well, yeah. So let's start. I think with some basic questions. You know what I mean, and then we'll gradually get a bit more, more intermediate, if you will. So let me just begin with I'm working with Doug for a while now. We've looked at a few deals. We have a couple more that he's going to be looking at as well. Just waiting for the seller to make up their mind. But we're in healthcare, obviously. Not everyone's in healthcare, but majority of the guys that listen to this podcast, they're in healthcare. So, if you don't mind, Doug, let me ask you this. So, based on your experience, right, looking at healthcare deals, what are like some of the things, just some of the basics that we want to, make sure that we know about the deal, the owner, as it pertains to like, hey, what kind of processes are we using? What do we want to know about the insurance, stuff like that? If you want to touch on that briefly.
Certainly, thank you. The Ansi's describing is what are the basic knowledge that we look to understand during what we call due diligence. And the diligence period happens before, certainly before the closing of the transaction, but typically some of it happens before a definitive agreement is reached, even when you're discussing early terms of letter of interest, et cetera. So with respect to any company, but we'll talk about healthcare and Ansi's particular question, you want to look at the financial history of the company. You want to understand its staffing to deliver the services that are offered to the client. To the extent possible, you want to understand the variety of non-necessary expenses which may be going through the business. For those who have employed a sell-side broker, those are typically described as add-backs. And then in addition, you want to look at how much of their revenue is driven off of insurance type of payments and or government, if you will, price mandated type payments to understand if there's risk in the future for that revenue decline, even if the same number of services are provided. Certain specialty practices have particular assets that are necessary to run the business. And by assets that are special, it's outside of the normal equipment that you'd be expecting in a practice. So it'd be unique practices, and I'll use a barometric chamber as an example of a specialty one, as opposed to standard equipment that you can buy from a Stryker or from any of the other brand name medical equipment providers. That would be the basics that you'd be looking for, and then you do a deeper dive in understanding competitive position of the market. But that would be a good start to be right there.
Yeah, so for example, like that hyperbaric deal that we were looking at, right? And it's more of a specialty, practice, if you will. So let me ask you this: the is it easier for banks to finance just regular, typical, medical practices versus specialty practices? Is that something that's easier to obtain, and does the banks look at these specialty practices as they're more likely to be more risk associated with them?
It's a great question, Ansi. And I'll speak to my experience as opposed to covering every single type of potential lender to an acquisition. But in general, I'll talk about the loan process. Um, any lending institution, bank or otherwise, has what's typically described as a credit approval process, usually a committee, and the lead banker who's developed that relationship with the potential acquirer will put together for his or her credit committee, a package of information about the business, about what the plans for the new owner are with the business. So that credit process then goes for approval up or down. So to Anzi's question about a specialty practice, in general, the more known or the more common a business is, the greater likelihood that the credit committee has seen a similar transaction in the past, just because of sheer numbers, supply and demand. And that makes it easier to get through credit. Not that a specialty practice won't get approved, but typically the level of information and the quality of the diligence will have to be higher so that the credit committee understands the risk. I mean, that's effectively what a lender is. They want to make sure they've got the ability to have the loan repaid and earn the interest, which is their profits. So in general, yes, it's more challenging to get financing through credit, but that can be mitigated by solid due diligence and working with the banker to make sure that the package that he's putting together for credit has all of the pertinent information that he needs to convince the people that are on the credit committee.
Okay, perfect. So, all right, again, just kind of sticking to the example of the hyperbaric deal, right? Now, what would that look like after the seller agrees to the LOI, right? So, what does a typical due diligence look like, just on average? Not again, just because you're familiar with the deal, the hyperbaric deal, right? What would that have looked like for us, right? Just to give people an example.
Certainly, I'll use there's some background noise, or whoever can put it on mute. The due diligence can vary by its length based on a few things. So my encouragement would be for any seller, whether you're utilizing a broker, whether you're utilizing just a lawyer or an accountant that you've known for a while, is have the normal information available, cleaned up for the prospective buyers. There's plenty of lists out there of the types of information that are typically requested for transactions. I'm talking having the basic information available. That'll save the resources of prospective buyers. And because the answer is, for a seller, you want to get to yes, because you're looking to sell. And the eventual buyer wants to get to yes. So making that as easy as possible will minimize what I call deal fatigue. So to Anzi's question about the length of time, one could expect realistically a month. Now that depends on if there's contractual revenue obligations that are there, size of the practice, and those other factors that I described before. But definitely done properly, a month for a smaller medical practice wouldn't be outrageous. But it requires the preparation that I described. It would necessitate a very specific request list from the prospective buyer. It would have the seller's lawyer or accountant having signed off, because and this is for those who may not be familiar with transactions, is that the information that a seller provides to the eventual buyer is typically it's covered under the final contract by what's called representations and warranties, meaning that you're going to represent the accuracy of the information that was provided. So having that information not just collected, but having it reviewed for accuracy and completeness becomes very important for both the buyer and the seller, but in the seller in particular, because they could be legally liable after the transaction's over. So it would be probably a month's time of the buyer, but there's probably another month to well beyond a month of the seller preparing the information before any prospective buyer begins looking at the specific information relative to the practice.
Okay. And now, for deals that size, because we're in the lower middle markets, obviously.
Correct.
So a deal, $2 million, $3 million, $4 million, deals that size, it could be done in-house, right? Given that you have a deal-making team or a board, per se. Now, in what instance would it be okay to have your, just the in-house team handle the due diligence 100% without involving any third-party professionals? Because I've heard that your in-house team can perform the due diligence, your lawyers and the accounting and the M&A guys, but you want a third-party professional like a law firm and accounting firm to make sure that in case that anything goes wrong with the deal, you have some kind of liability, or basically someone to point the finger at, saying, hey, those were the guys who, checked the number. So,
sure.
Yeah. So,
yeah, sure. There's a bit of a trade-off relative to terms within the sell agreement in terms of what protections are afforded the buyer from the seller. Can it be done in-house? Yes, it's a question of risk tolerance and comfort level of an in-house team. I think fundamentally what Anzi's question is getting at has a few dimensions. First of all, you want to understand how the business is being run. So there's that operational aspect. Then there's the financial performance, which, the historical performance being verified, it doesn't guarantee future success. But if the forecast that a buyer puts together, which is also used, the term is called pro forma, that is effectively what earlier when I described the lender's lead banker, that's what that lead banker and the credit committee is going to rely on, that pro forma forecast, as understanding the company's future ability to pay back its loan. So if the basis is wrong because financial information is misrepresented, then it makes the forecast wrong. So that's where it comes in. Having outside parties involved in it really depends in some respects on the talent of the team, as I shared before, the risk tolerance, and really the sophistication of the type of practice being purchased. So those are decisions that the in-house team can decide whether it's got the capabilities or whether to augment with outside experts. I think the last aspects, we talked about operational diligence and understanding how the practice works. We talked about financial diligence, which is what the historical numbers do. And then there's the legal diligence, this does typically happen from outside firms unless someone on the deal team has a background in law, confirming that the business is incorporated correctly, that the contracts are robust and valid, that understanding both the tacit liabilities and the potential liabilities that come through contractual arrangements, et cetera. So that is typically where lawyers can become involved. And then it becomes a trade-off as how much needs to be done. Can it be done via sampling? Does everything have to be reviewed? But going back to my comment that the information provided will be repped and warranted. A lot of the information will be referred schedules that support the purchase and sale agreement. So it's not just the buyer that's employing outside parties potentially to go do that. But if the seller has those types of experts, then there needs to be a decision of who can interact with that counsel on the sell side. So I don't want to overspeak to the question that Ansi asked, but the broad answer is it depends, but those factors can be discussed very quickly to understand when and where you need out support.
Okay, perfect. So, for example, could we perform our own in-house due diligence? Given that, okay, so you're an M&A guy, obviously, you've done tons of transactions over 25 years experience. We have Gerard, which he's an M guy from Deloitte. We have James, we have our accountants. So, would a team like that suffice to pull off a due diligence on our own? Also, and can our in-house accountant provide a quality of earnings?
My expectation, and granted, like I shared, I don't know every potential acquisition possibility that's out there, but the team that Ansi describes is absolutely capable to handle the diligence of the type that Ansi described and in the segments for which Blue Horizon is targeting.
And we're able to pull off the accountants could do a QOE, right? And let me ask you this: is there a difference between an in-house team doing a quality of earnings versus a third party doing it? Is there any significant difference?
Well, in my experience, the question is what the quality of earnings is for. The typical quality of earnings report is somewhat done from a compliance perspective, again, to make sure that that the historical financial information is represented accurately, as opposed to being utilized to formulate that version of the pro forma that is used to go secure financing. So depending on resource availability, is the in-house team going to spend their time on verifying quality of earnings to an extent that an outside accounting firm will? Or will they take that information and do selective audits or selective checking, but then spend their time creating that forecast? Question is, it depends, like most things do, but it's certainly the process should be the same, whether it's internal or external, but the depth, it's driven by the depth of detail that is desired from the quality of earnings review. I think, Ansi, I skipped a portion before when we discussed diligence, and this is probably important to that question you asked about timing. And diligence should be done in phases, both by the seller and the buyer. And when I say by phases means if a seller has 5 prospective buyers, it's very unlikely, in fact, it's unwarranted to show all 5 of them every bit of information that's been collected, to show all 5 of them access to certain confidential proprietary information. Now, each of them may give access to, for instance, a site visit and a management interview, and then some basic information, and then at a certain stage decide, okay, are you still interested? Give me an indication of that, et cetera. And then that list of prospective buyers is important to those likely to be able to close the transaction, and you show 1 or 2 or 3 parties more information. So that's the type of information that a decision that a seller will work through with his experts, whether it's a broker, whether it's a lawyer or an accountant. What that helps them is that they don't waste their time on not likely to close a transaction. And on the vice versa, prospective buyers, their time as well, like Ansi's description of all the team. You buy people spending a month on a project that's not going to go anywhere, an acquisition that's not going to go anywhere? Or would you rather have 5 people spend a week or less on that very first phase to see if there's true interest and then move on? So my commentary about the 1 whole month, was imagining a beginning to end process when it's probably broken up into chunks of a week here on the first phase, 2 weeks on the second phase, and the fourth week in that example, finalizing the negotiations for the definitive agreement and finishing up diligence. So it's not one continuous thing, or I wouldn't advocate that, and most sellers don't want to do that anyways.
Okay. So when does the bank come into play, right? What's their role? When do they make
it depends. Certainly, a bank will become involved in some capacity as early as a prospective buyer wants them to. Now, depending on the type of buyer, do they have cash in hand or commitments from investors, or whether or not they're looking to finance each transaction individually, that can vary. But on a team working with their prospective lender, working with them earlier, understanding what they need to see for credit, understanding the quality of the output, whether it's a report, et cetera, that's required. I advocate working as much as possible, but also not doing it to where you're very cautious on making sure information doesn't get out. In terms of early test on here's about the size of the acquisition, understanding, hey, we're looking to maximum leverage of X, make it up 75%. Understanding those things early in the process makes that pro forma creation process that I described before, makes it a lot easier. Because if you did all the work at the end and then you went to the banker and said, okay, here's the deal, we want this to be approved, and they mention 5 things that weren't covered in diligence or in discussions with the seller, that can just push things sideways. So in the context of the month I described for diligence, you should be having conversations, initial discussions with the bank that first week. The project manager should be. And not that the bank's going to start doing something, but you want to start understanding, when does the credit committee meet next? How easy or difficult is it to get on the schedule? What's the typical timing for approval? And even, in terms of once it's approved, length to close, understanding those things will help the whole process for both the buy side and the sell side. So early in the diligence process, you should start those conversations and then look for your banker to guide you as when deadlines need to fit into the overall schedule.
Okay, so I have some lenders who say they would come in, pre-LOI, post-LOI, but obviously you want them really coming in post-LOI after you have a signed, it's signed by both parties. So some banks, or I guess most, will give you a rough term sheet. How accurate is that? And, is that something we could actually go off? Saying, okay, well, they give us a rough term sheet, and we know for a fact that this is what the bank is willing to lend on. So that rough term sheet, is that something that we could take as face value?
Yeah, there's always some movement around whatever terms are. A bank doesn't want to be exposed in lending to something when they don't have 100% knowledge of that, but they're not going to deviate to such a degree. So it's important that that term sheet has enough meat to it so that there's credibility on the seller side. But in the same breath, the letter of intent will very likely be non-binding at that stage. So there'll be enough wiggle room that if things would change, that it's not such a shocker that it scuttles the deal. The real question becomes, is it if the terms change, value proposition company, I shared before, there's got to be enough language around final adjustment of price and terms to make sure both parties understand the risks and understand how locked in those terms are once it gets to a definitive agreement. So it'll be close, but it doesn't necessarily have to be exact, but it's not going to change. It shouldn't change by a material amount unless something was overtly skipped at the beginning discussion with the banker.
Okay, so this is a question I know a lot of people have, and we actually I asked you this a few months ago. I'm not sure, maybe 3 months ago, but a lot of people want to know how exactly do we get paid when we make an acquisition, because there's a lot of chatter that's going around. It's like, hey, you get paid bonus, you get paid a salary from the business. You know what I mean?
Sure.
You overfinance, you get paid, right? If you're bringing in investors, you can ask the investor for, I guess a percentage over whatever you actually need, right? So can you shed some light on this myth for us?
When you're asking the question, Anzi, to make sure I answer it correctly, you're talking about the seller. How do they get paid?
No. Us as a buyer, right? When we make the acquisition, how
Sure.
do we get compensated? And also,
Sure.
you did mention some management fees, right? So if you could touch on that a little bit for us, that'd be helpful.
Absolutely. I'm going to provide some groundwork for where I've been operating in the mergers and acquisition space. So, which has been primarily either publicly traded, but in Anzi's question, it has to do with private equity and or private investor type money. So the investment for Horizon for the PE type funds, private equity type funds, is 5 to 7 year hold period. That's the target. It's typically set out in their initial offering to the group of potential investors that they go raise funds from, et cetera. So in a PE world, there's we can put a hypothetical number, doesn't really matter what the number is, on those funds. And X percent of the funds done, and let's just use 1% by example only, because it could be larger, it could be smaller, depending on the size of the fund, are dedicated to the expenses, if you will, of just the personnel and the operating costs to manage the investment process, both in the pre-acquisition phase, to the acquisition phase, ownership phase, and then for the sell side. So there's fees generated from that. Now there's also, so from that's Anzi's management fee. Also, you may have partners of said private equity fund. They can be investors as well too, so they're going to ride the financial upside of doing that. There's compensation from that as well too. So it really comes into.
I'm sorry, real quick, as far as the management fee. So just to sum it up, we charge the company a management fee, right? It's the company.
Correct. That's how the private. You're correct. They charge the management fee to the company itself. I mean, that's how you cover overhead. But the private equity firm will also typically get fees out of those committed funds to their. Anzi, you made a description earlier. Is if you raise X funds that exceed the acquisition price, those fees net of should cover all of the expenses related to it. So it may be a deal generation fee, et cetera. So there can be two aspects. There's a fee generated from the investors if it's a true private equity fund, but there's also fees charged to the management, to the company that's been purchased. So you'll have the private equity firm will be a separate legal entity from the practice that's purchased, so that future practice in whatever form it takes, LLC, LLP, et cetera, will pay some fees, some management fees up to that private equity group on whether it's quarterly, semi-annually, or annually basis. That's to be decided, but that's what Anzi's asking about.
Yeah, so a lot of people also want to know. All right, no, before I even move on to the next question. So as far as the working capital that you get from a business, how do you calculate how much working capital any business need? Do you go off the monthly operating expense of the business and you add that up for a certain amount of months that you would like, maybe 6 months or so?
Sure. Well, from any business that is solvent, and let's just imagine right now that the business has been stable over time. there's a certain amount of working capital that the business is needed to stay open. And the number doesn't matter for our discussions, but over time, let's pretend a practice is needed to have $100,000 more in current assets than in current liabilities. So that's the working capital, that plus $100,000. If that business has needed that working capital cushion historically over time, that is the ideal number that a buyer wants to have on day one when they start. Now, there's always a question of how do you get there? Do you purchase the working capital? Do you let the owner take care of all of it, meaning that they can take the cash, but they also take the receivables and the risk of collecting them? Do you have to, you're going to have to set up your own credit facility with a bank. So do you need to go, do you want to actually fund that with equity dollars? You probably don't. So the idea that ANSI is getting to is that ideally when you buy a business that's a going concern, you also want to purchase in some fashion the working capital. I'm not talking about the cash, because cash dollar for dollar doesn't matter. The buyer will buy accounts receivable at a certain percentage of its book value. They will potentially take on the liabilities and therefore have working capital. There's different mechanisms that lawyers will guide you to and whether or not liabilities should be purchased, et cetera. But that's the idea, is if you're buying a business, you're not just buying hard assets. You're buying assets, you're buying working capital, and you're buying blue sky in a lot of cases, meaning there's value for the business above the book value of assets. So those are the three items that are purchased, if you will, in a transaction.
Yeah. So just touching back on the hyperbaric deal one more time. There's something that you told me, because a lot of people they get a lot of this is negotiation, a little bit of motion tactic, if you will, but a lot of people, they have a hard time dealing with either the seller's wife, broker. But there's something that you said to me, is I believe it's something to the tune of, ask Debbie how she would finance that deal, because she had a finance background. I'm not sure if you remember what I'm trying to recall, but you told me to ask her, hey, if you could show me how to finance this deal, or if you could show me a bank that will finance this deal, we would take it. So that's basically a way of basically saying, hey, we're interested in a deal, but if you yourself, the terms that you want, although it's not going to meet our requirements, show us how to finance the deal, and we will be able to finance the deal. And I just thought that was a great tactic, that could be used with some people out there that's having a hard time, negotiating deals with these sellers, especially when they're asking for unreasonable terms. So let me ask you. Yeah, go ahead.
Yeah, I think what you're driving at, Anzi, if I step back for a second, many business owners, in fact, most business owners that I've ever known, have a tremendous sense of pride in their business and what that accomplishment represents. And that is both a great thing, because that passion has gone to create solid customer relationships and other very good qualities of the company. On the other side of that, and this is not a slam on business owners, many business owners have a belief that the value of their company is much higher than its actual value. So in Anzi's description on a real transaction that we looked at is, from a tactical perspective, arguing with a seller in an area that touches the nerves of pride in their business sometimes can appear to be combative when it doesn't need to. So in that example that Anzi provided, is that when there's a position difference between potential buyer and potential seller, sometimes you ask them to explain it in a different way to make them work through their logic, to put aside the emotional attachment they may have to the sale. It's not manipulation, but it's trying to change the discussion, if you will, point of view. Because if they do have an idea that's workable and it's something that the buyer overlooked, hadn't thought about, etc., you don't want to assume that your team has all the answers or that your way has to be the right way. The goal is to close the transaction for both buyer and seller. So putting everyone's best mind into how it can work, it never hurts to ask that question. Hopefully that helps.
Yeah, absolutely. Again, it's a great negotiating tactic. It works well. So let just take another a different turn, if you will. You know me, I'm just starting out in this when I reached to you. Still have no experience in this. Gotten a little bit better. But again, our audience, by and large, they are starting out as well. So if you can, I'm not sure if you have on this, but what because a lot of people say, hey, build a team, get the best of the best guys, and then get a law firm to represent you, get a big four accounting firm. How practical is it as a startup like mine to have such high profile law firm like McDermott or number one tier law firm, big four accounting guys working with us? How feasible, how practical does that make sense?
It's a combination. Certainly, if money weren't an object, we'd all want the best professionals advising us in every aspect of a transaction. So the question becomes, going back to my example earlier, let's use a month as the timeline for diligence and an additional few weeks to get the definitive agreement in place and closing. Is that a decent work plan from one of those firms? You should be able to create a decent estimate for what that cost will accumulate over time. Without oversimplifying it, a medium-sized transaction can be just as expensive from advisors as a smaller transaction. And if you imagine that the costs of third-party advisors effectively are just part of the purchase price, it means the financial success of that business going forward has to be of an amount to cover all of the expenses that are incurred during diligence, during the pre-closing activities, et cetera. So my point about that is that, and this is an exaggerated example just to make the point. If you had a $100,000 practice that you were buying and you were going to spend $50,000 over a month and a half to get the transaction closed, you've, in that example, just raised your purchase price by 50%. If it's a $5 million transaction and it costs you $60,000 to do it, it's a 1% number. It's just over a 1% number. It's a far different justification of how much expertise you want to spend on doing it, how much time you want to spend on doing it, et cetera. So the answer is you want to get the best team that you can for that, but you also have to keep your eye on the prize, because as an acquirer, the typical success rate for an acquisition is about 12%. So in the example I just gave, if you spent a month to 6 weeks on 9 transactions that didn't go anywhere, I'll go back to my $50,000 example. You just spent almost $500,000 for unsuccessful transactions from your fund. You need to make that up somehow in terms of profits from the businesses you do own. So you've got to be very judicious in when you use outside, because those firms are well paid because they're the best of the best and they've got high demand on their services, et cetera. So it becomes a trade-off for how much you're willing to spend for projects that may not go anywhere and how big the project is.
So does it make sense to have, for us, again, like guys like myself, like us, to be in the lower middle market, looking at deal enterprise value of 1 million to, I mean, maybe max 10 million. I'm not even going to go there because a lot of guys
Sure.
do. Let's just say 1 to 5 million enterprise value. Does it make sense to bring on, let's say, KPMG, right, to perform due diligence on the accounting side when
No.
they're going to?
The short answer is no.
Okay.
And I say that because, notwithstanding, there are fine accountants at smaller regional and local firms if that functions necessary. There are good transaction lawyers that work with smaller firms that have experience because they didn't like the big firm life. When you need those experts, it's nice to have big names, but on the smaller transactions like you're describing, that's not a necessity to use the big name firms. Not that they don't provide good service, and not that they're not value for what they're at. Value relative to the transaction size, you can find those services typically elsewhere or develop them within your team. If your team's got a lawyer who's got that experience or accounting background, you don't necessarily need it. It's notwithstanding that there might be some situations that demand them. And I'm not putting down the example of KPMG or another large firm, but on the smaller transactions, it's very difficult to justify.
Okay. And I would say that goes, without saying, for the law firm as well, right? There's no reason to bring in a, top tier law firm for that same exact reason, I suspect.
In my experience, that especially in a market that your firm operates in, Anzi, by way of example, there are plenty of specialty boutique firms, both accounting and law firms, that would have that skill set in-house to utilize when you need them. And if you keep them on a very narrow plan as well, in terms of the areas, the scope that you want them to perform, you're going to get what you want with good project management, and you'll spend a third to a half the money at the most. So it makes sense to know your local boutique firms in both legal and accounting when you need them.
Okay, so another example, right? Because again, there's a lot of talk about, hey, get the third party professionals, law firm, accounting firms on success fee basis. How practical and realistic is that in today's age, 2021? How practical is it to get a good firm, not even a top tier like we mentioned, just a regional, good boutique firm? How practical is it for someone with zero experience, just like myself, exact scenario, right, that just put a team together to say, hey, we want you to work on success fee basis with us? How practical is that?
Great question. I put the probability as low, but it depends. Is it a one-man shop? Is it not? The challenge is, without a long track record, the ability for someone to judge the probability of success is challenging. Let's use a single lawyer or a single accountant. You have about 2,000 working hours on a decent year that you can bill. And going back to my example, a month, 160 hours. So to ask that person to take the risk on losing 1/12 of their available billings for the year for a project, which I told you has got 12% probability of success, you're asking a lot from them. So I'm highly skeptical on that approach. And my concern, and I would never accuse anyone of doing this, my background's economics, so price signals, et cetera, is that I don't want bad incentive for any person, whether it's an in-house team or external, to want a project to get done just so they get paid. Again, not accusing anyone of anything unethical, but if the financial incentive is to make sure the deal gets done, the deal can get done and risks cannot be addressed. And I'll share you some quick experience about why I think that, Anzi. My early corporate career was with an energy company that was number 3 to Enron. Enron was number 1 trader, Dynegy was number 2, and the firm that I was with was number 3. And there was an incentive system in place that basically encouraged very risky behavior, because the downside to your career, if that risk didn't pan out, you had more incentive to go take risks, etc. And so it creates a very bad environment that people will take risks that are higher chances of happening, and you don't have the cushion in your business plans and in your terms and conditions, etc. So I'm speaking from my experience that I don't like to create malincentives from the deal team, and I can understand in a startup business the desire to save money, but I would hate for it to create a desire bad deal get done. And with deals, but bad deals can get done on the roads.
That makes a lot of sense in a different perspective. So let me ask you this: what a startup company like mine starting out, what are some ways, if there's any? Well, there are some, but let's obviously avoid the bootstrapping, idea. But what are some other ways that someone could raise the capital to cover, expenses like that? The professional fees, the due diligence fees from investors, without giving up a lot of equity in the company, because that's a lot of concern.
Sure. That's a good question. Honestly, Angie, I'd have to think about that. I'm looking at the time, and I don't know how long we've got. I'd like to get back to people on that. If it's important, I'll get to it before the end of it. Do we want to open it up soon to questions?
Yeah.
Yeah, we got a couple questions. So, first one is from Josiah. He said, "Wet representation and warranties. Is that a separate contract that you have the seller sign?"
No, typically representation and warranties are part of the definitive agreement, which is the buy-sell agreement. It's actually a section. You represent certain things and you warrant, meaning you guarantee their accuracy afterwards. So it's typically a section of the document, and your lawyer would be aware of them. And my example would be is you're going to represent that all the information is correct and accurate to the best of your knowledge. And that's just an example. It's something you're saying, I'm pledging that the information I gave to you is good. So it's part of the contract. It's actually typically it's a very specific section in the document.
Great. Now, Chrome asks, what are some creative deal structuring techniques when using an SBA loan for acquisitions? Being that you are limited to buying 100% of the business and there are no earnouts allowed, correct?
I'm not an SBA loan specialist, but that being said, there are ways to address some of those concerns, and the options are too much to discuss here, so I'm not going to discuss SBA loans. But is the former owner going to stay on as an employee or as a consultant? So that's correct that SBA loans do have limitations and those types of things, but that doesn't mean a transaction can't be done. The question of how do you pay for value, you've heard me discuss it before. If the owner for a business is asking so much where a loan can't be had, then the market value of that company is lower than what the owner wants to sell it for. So I'm not trying to be roundabout with that answer, but there are ways that owner compensation can happen even with an SBA loan. We discussed working capital negotiations earlier. You're correct about the number of owners, but that becomes a different discussion as well too on how you structure your acquisition vehicle. So I appreciate the question about the SBA loan, but as with everything, there's some flexibility around the edges that I would examine.
The last question is, Anthony asked, are the financial institutions looking more at EBITDA or unlevered cash flow to satisfy their DSCR?
I can tell you what I've seen. It's a combination. Do they do the levered cash flow for analysis? Yes, but from the perspective of a lender, I mean, they're first in line before the equity. EBITDA it's a less subjective number from this perspective in a forecast. Levered cash flow has two aspects. Leverage means the amount of debt. So, like I said, with respect to a lender, you're the first recipient of the cash. But levered cash flow would also imply changes in working capital and investments as well too. And depending on the practice and the business you're buying, do you have to buy certain equipment next year, or can it be deferred for a year or two? So my commentary on that example is that there's more subjectiveness to movements in cash flow that are beyond just the performance of the business. It has to do with collections, it has to do with capital investments, etc. So EBITDA is certainly the first pass at it because it speaks to the quick cash generation of just operations, not those other aspects. Will they look at leverage and capital expenditure? Yes. My experience in banks, though, also when you start talking about leverage cash flow, are you talking about like waterfalls in the debt in terms of restriction on the cash? Are you talking about them doing discounting and things along that line? My experience is that the credit committee is not going to be looking from a discounted cash flow basis, but that they still want to understand that the business plan is robust. Back to my example about capital expenditure, you might be able to delay a year or two on a big capital spend if it's necessary. But if the company was spending $1 million every 5 years and your forecast is that you're not going to spend any money in the next 5 years, if I'm the lending officer who's taking that business plan to the credit committee, I'm going to ask you how it's possible that the investment's not going to be made. So EBITDA would be the first look, but your cash flow definitely comes into play. Less so in a medical practice, unless it's a specialty with large capital equipment expenditures. But we could broadly talk about a medical practice that's got an MRI machine or a hyperbaric chamber that I mentioned earlier. So it could be more important for some businesses than other that cash flow becomes very, very important for credit. Hope that helps.
We got a couple more questions.
Please.
Yeah, so Josiah asked, what is the best approach to the bank when asking for working capital? How does the structure look essentially?
Separate working capital facility. Don't tie it up into the loan for the business. Actually set up two different loan vehicles, if you will, a working capital facility and the acquisition debt itself. I mean, they're different type of instruments anyways. So you're going to want to make sure you work with the lending officer in terms of doing that. Some banking entities have greater experience with certain types of industries. And this is a silly example, and it's not pertinent to this one, but you'll see the point. General Electric, GE Capital used to have an incredible program for franchise restaurants. So in some respects, there are certain lenders or certain banks that it might have profiles that you deal with for practice, for your particular type of practice that you're trying to finance. And so besides setting up those two different types of facilities, when you approach lenders, see and ask about their experience in your niche that you're looking at. That's probably the more important part of it. Going back to the comment I made at the very beginning of this, it's because if they have more experience lending in that space, then they already know what they want from a security perspective and how they want to do it. So, bankers know to have a working capital facility and a loan, you want to see how many they've done, and that just makes your whole process a lot easier.
Right. Other question?
Chrome asks, as far as goodwill as part of the purchase price, as a rule, is there a certain percentage of the total sale price it should not go beyond paying when paying for the business?
There's no general rule of thumb, but let's talk about, and I'm trying not to get too technical with this. When you acquire a business above the book value of assets, one area that'll become important is looking at the market value of the assets. And the reason why that's important and why a third-party accountant may become very important is because the tax deductions from depreciating those assets in the future. So my example is, if the assets on the books are worth $100,000 and you pay $1 million for the business, it doesn't mean that there's $900,000 in that example of goodwill. But when you allocate purchase price towards those assets, some assets may be worth $200,000. Another tranche of assets might be worth an additional $300,000, et cetera. And those will have different tax lives. So my point about that is that paying too much money in terms of goodwill doesn't necessarily, it has an impact on your tax deductions in the future, which, going back to the previous question, has to do with that levered cash flow. But going back to that is, can the cash flow cover the debt? So fundamentally what a bank wants is they want enough cash flow coming out so that worst case scenario, that loan's going to be paid. Let's pretend it's a 4-to-1 ratio of cash flow to interest expense because you've also got amortization. So they care about the cash flow. Now, the question asked about, is paying too much in goodwill, is there a rule of thumb? My example would be that valuations at the end of 2020 were approximately 12% higher than at the end of 2019. But that doesn't tell the whole story. Valuations, and if everyone remembers COVID, valuations in the May-June timeframe of 2020 were about half of what they were at the end of the year. Now that's the stock market, but there's those influences in the capital market happen. So you're saying, wow, effectively valuations doubled between the low point and the COVID problem last year and the end of the year. But the businesses didn't necessarily change in value that much in terms of just what they were generating from operations. Because on average, businesses dropped about 20% last year. That's just a rough average. So valuations cut in half, but business only dropped 20%. It's always looking, always, always, always fundamental. Can you pay the debt? Do you have enough safety if there's a few hiccups that you don't become a problem with the bank? That is fundamentally where valuations always answer. Now, I'm not, again, trying to make this too complicated an answer. If I go back to the initial one, my comment, valuations are up, meaning for the same company, businesses are more expensive this year on the whole. That means as a buyer, your need to create value with your business plan. You need to create more value to pay for that extra price, which means you have to have better due diligence because you want to make sure that forecast you give to your lender can be delivered on. A, will get approved, and B, that you can meet that loan payment down the road. So the limitation is how much value you can credibly create in the next 5 to 7 years if you're a PE type investor. So, no one would have believed that valuations would be as high as they are, which they're at record numbers right now. And yet we're doing diligence on companies every week because there's money being lent to buy these companies because lenders are confident with where the business market is. There's a lot of money willing to finance transactions right now. The banking market hasn't tightened up. So any rule of thumb from the end of 2020 is a 12% higher number than it was in 2019. So go to the business plan. Is it solid? Do you cover the risks? And can you generate the cash to pay the loan and still make a good profit for yourself? I know that's oversimplifying, but it's much better than thinking of rule of thumb because there's value opportunities in financial engineering. There's value opportunities in better supply chain planning, procurement, logistics, and operations. And there's value opportunities in your overhead costs. And if you've got a good plan that captures that value, that rule of thumb goes out the window anyways. So don't get caught up on that. Now, you can look at where transactions are happening in your industry right now, and that's a good guide, but don't let it be the only thing you think about because you may have a business that you're looking to buy that's not going to perform as well as all of the other transactions that have happened lately. So you want to use that as a good, if you will, directionally correct signal, but you got to do your homework on that company. So hope that helps.
So, hey, real quick, sorry, Doug, would we still be applying that 20% rule right now in 2021 for businesses, or is is the environment kind of settling down with COVID?
It's interesting. Yes, no, businesses are starting to rebound. My overall description would be this, and that doesn't apply necessarily to healthcare. I mean, healthcare had a slowdown because a lot of practices, depending on where its focus was, were impacted because a lot of discretionary and not elective procedures were stopped for a while. From a medical perspective, most of those restrictions aren't happening anymore. And I can speak to that because I happened to have hernia surgery one business day before they stopped doing elective surgeries for 2 months at the hospital where I had it. So, those things have changed. In terms of the overall business market, it's, if you will, COVID's caused winners or losers. And this is not going to surprise anyone and beyond the purpose of today's call. I'm not sure I'd want to own a restaurant or a bar right now. A liquor store, by all accounts, with where sales have been in the last year, might have been a good investment. So, I use 20% as an average because that's really what the numbers have said overall. But the bounce back is pretty apparent. I mean, the fourth quarter numbers are solidly above the third quarter that are coming out from various federal agencies. And in particular, now that hospitals and other medical providers have, now that they have the double masking and all of the, the limitation on visitors, et cetera, there's no reason to believe that they won't return to normal as patients and customers start going back to their normal behaviors, especially now that the vaccine is being distributed widely.
Okay. Go ahead, Valentino. Let's take some more questions. A
Yeah,
few more.
that was great. So Chrome also said, if I was approaching you to become a consultant for my company, what would catch your attention and get you to say yes to a startup?
That's a great question. Um, I'm trying to avoid the answer to everything in terms of a startup company. Like Anzi's company is a startup. So as a consultant, you have an orientation towards working on projects that are fulfilling, and I'm talking about the non-financial motivations. Like I enjoy working with Anzi because I truly want him to be successful. I've worked with established private equity clients for years, and I would like nothing better than at the end of my career to look back and see that Blue Horizons has accomplished the goals that Anzi set out in our first conversation. In terms of any consultant, as I shared before, the likelihood of many of them willing to take contingency fees, it's probably limited. So the consultant's going to want to know, are they eventually going to get paid? And are you the type of business person that'll take their advice? And I know that sounds all interpersonal, but I think that really becomes fundamental when you put aside the financial, are they going to get paid? Are the prospects of success there? Can you help them? And are you a part of the team that can help them be successful? I mean, I think those elements are key for creating any successful business anyhow. So I don't think that is new advice for any good business owner anyways, but it's what motivates me.
Right, Doug, here's a pretty interesting question. I haven't seen this one before. But he also asked, with Amazon Pharmacy, do you see independent pharmacies now as a bad investment?
I have not in my career had the opportunities to look at pharmacies. It's been well established that Amazon has been a disruptor. There's also a demographic move, towards which demographics want to still purchase from traditional brick and mortar versus comfort with e-commerce. And we saw e-commerce setting gangbuster records in 2020. So I can't answer whether Amazon Pharmacy is going to be a competitor, but we'd also probably want to talk about, is it a pharmacy from the Walgreens CVS model where there's a bunch of other ancillary products besides pharmaceuticals being sold? Is it specialty? And my reason for saying that is that there's some very, very successful compounding pharmacies that I'm aware of, not that I've done advisory work for, but have a very solid niche in the town where I used to live. And they do quite well, and they're not worried about it because obviously they're compounders. They work on products that have generics that are, that are authorized in the market. So we could discuss that further if you want. We could figure out how to do a follow-up. I think it's a valid concern to be looking at industry disruptors like Amazon or like other competitors in other industries. But I don't want to comment on that because I lack the experience in that particular one unless I had more information.
Douglas, thank you very much for your time. Any last comments, Nancy?
Nah, just last remarks. Appreciate the time, Doug. As always. But what we're going to do is, like you said, we want to bring you people that's actually serious, about your services. So we have a few guys that's actually, looking at deals, in the deal phases. So we're going to connect you with those guys. and those are the the top guys. They're serious. Again, we don't want to bring in anybody that's going to waste time or anything like that. And like you mentioned too, having someone work on 9 deals with or any amount of deals, and having them not be successful, it wouldn't be fair to that person. You know what I mean? It wouldn't be fair to anyone. So we're definitely going to connect you with the guys that are in the deal stages right now, making it happen. But again, appreciate you. We definitely have you back for another session, to expand some more on the, I guess, the more intricate part, if you will,
Okay.
about M&A. So yeah, we definitely
Well,
appreciate you being on. Yeah, go ahead.
Thank you very
well,
much,
I
Doug.
hope I know, no problem. I hope the audience had got some value out of that, and very much appreciated, gentlemen.
Yeah,
They're
yeah,
telling
of
you
course.
thank you as well. So I appreciate your time again.
Yeah, so
Okay.
hey, Valentino, yeah, we'll get Doug's information, and we'll share it with the guys who need his service
Yeah,
right
so
now.
the people who are working with us, the serious ones that we're, basically overseeing, that we know they're in the deal flow stage and they got financials, we'll see what your intentions are moving forward with those deals. And if you're willing to close on them and put in the work, we'll refer you to Doug. Otherwise, keep pushing.
Yeah, I like it. I like it. So enough said. Again, thank you for the time and the expertise, and the insights, and definitely looking forward to having you back on.
All right. Thanks, gentlemen. Take care.
Take care, Doug. Guys, billionaire acquisition mastermind, #1 in the world. Thank you very much. If you guys want me to, we could get a list of more in-depth questions. We could bring in Doug for another session. Other than that, we're going to keep moving forward with the interviews. We got a lot of new people coming in, and I'm just setting up the equipment. We just got new proper equipment, so I'll be